For years, Enron was seen as one of the smartest companies in America. Investors loved it. Analysts praised it. In 2000, Enron was ranked among the most innovative companies in the world. Just 1 year later, it collapsed in one of the largest corporate scandals in history. So how did a company valued at more than $60 billion fall apart almost overnight? Enron started as a traditional energy company, selling natural gas and electricity. But in the 1990s, it reinvented itself as a trading company. Instead of just selling energy, Enron began buying and selling contracts tied to future energy prices, much like a financial exchange. This shift allowed Enron to use a controversial accounting method called mark-to-market accounting. Under this system, Enron could book the estimated future profits of a long-term contract immediately, even if the cash wouldn't arrive for years or ever. If a deal was expected to make $100 million over 10 years, Enron could record much of that profit up front. On paper, earnings looked strong. In reality, cash flow often wasn't. As some of these deals underperformed, Enron needed a way to hide losses. That's where special purpose entities, or SPEs, came in. These were off-balance sheet partnerships designed to move debt away from Enron's main financial statements. By transferring failing assets to these entities, Enron made its balance sheet look healthier than it really was. But many of these partnerships were secretly backed by Enron stock or controlled by Enron executives themselves. That meant the risk never truly left the company. At the center of this structure was Enron's CFO, Andrew Fastow, who helped design and manage some of these entities while personally profiting from them. This was a clear conflict of interest and a major violation of corporate governance. By 2001, cracks began to show. Analysts started questioning Enron's opaque financial statements. Investors noticed that profits were rising, but cash flow was not. When Enron was forced to restate earnings and reveal hidden debt, confidence evaporated quickly. Enron's stock price collapsed from over 90 per share to less than $1 within months. In December 2001, Enron filed for bankruptcy, at the time the largest in U.S. history. The fallout was massive. Thousands of employees lost their jobs and retirement savings. Arthur Andersen, Enron's audit firm, was effectively destroyed after being convicted, and later cleared, of obstruction of justice. New regulations followed, including the Sarbanes-Oxley Act, which strengthened corporate governance and financial disclosure requirements. The Enron scandal wasn't just about bad accounting. It was about incentives, transparency, and unchecked complexity. A company that looked incredibly profitable on paper was quietly accumulating risk behind the scenes. The lesson is simple but powerful. When a business is too complex to understand, and profits appear disconnected from cash, something may be wrong. If you want short, fact-based explanations of major business events, subscribe. New videos every week.